Hello everyone, wherever you are. Welcome back to Deloitte Canada's transfer pricing series on financial transactions. Today's topic is located on the second branch of the complexity tree and focuses on interactions between tax and treasury. It will be presented by Golodniuk, a transfer pricing specialist and financial transactions expert with Deloitte in Toronto.
Let's consider the role that tax and treasury play in pricing of financial transactions, their expertise and interactions in this new environment. Since financing structures have treasury elements, when it comes to structuring and pricing financial transactions, these are often seen by tax departments as natural expertise areas of the treasury specialists. Treasury's mandate and objectives, however, include efficient cash management and financing throughout the entire system. Often, treasury function is centralized. Its mandate pertains to financing of the entire corporate group and is, of course, implemented on line of business basis rather than individual entity basis. Tax compliance, including transfer pricing compliance, is at the individual legal entity level, and transfer pricing is determined at the individual transaction level. Inherently, the Treasury may not be aware of taxation implications of their activities. For example, negotiations with external lenders may have tax implications on transfer pricing of related party debt. Cash movements may have domestic and also international tax consequences. In the current fast-paced transfer pricing environment shaped by global actions on BEPS and increasingly aggressive tax auditors, it is critical for the tax and treasury to work together on planning and implementing intercompany financial transactions. Not all financing arrangements will work from both treasury perspective and a tax perspective. Transfer pricing jurisprudence rules and practices vary by tax jurisdiction. For example, Canada has several landmark court rulings influencing pricing of debt and guarantee transactions. The Netherlands and Australia have issued specific administrative positions of their tax authorities on transfer pricing of financial transactions. Bringing together transfer pricing expertise and also capital market expertise of the Treasury specialists allows to properly address all relevant aspects and to ensure tax compliance. Credit risk analysis for transfer pricing purposes need to formally address implicit support from the parent group. One of our segments is discussing the concept in more detail and how the profession analyzes existence of the parent in transfer pricing of financial arrangements. In the context of coordination between tax and treasury, I would like to mention that the OECD transfer pricing guidelines now clearly address implicit support, and also there are publicly available methodologies of credit rating agencies on assessment of implicit support. Practices followed by Treasury practitioners may or may not produce similar assessment of borrower and loan credit risk. The main message here is first to be aware of potential differences in transfer pricing and Treasury approaches, and second that tax and Treasury teams ideally would work together and coordinate from the day one of transaction planning. Transfer pricing rules require using data on actual individual transactions that are suitably comparable to an intercompany transaction under analysis. Tax authorities tend to dismiss interest rate quotes and market statistics, which are not actual transactions, of course. Interest rate pricing, following a build-up approach, starting from a risk-free rate and adding applicable risk premiums based on market and experience, may be a useful checkpoint. To be acceptable from a transfer pricing perspective, such pricing needs to be supplemented with analysis of actual transactional data. Transfer pricing guidelines suggest also considering alternatives that are realistically available to the borrower and lender as relevant to determination of arm's length prices. Transfer pricing specialists are experienced with pricing methodologies and can perform pricing analysis acceptable for tax purposes. Treasury experts are active in the market raising external debt and have first-hand information on financing options available to them and on their transactions with unrelated borrowers and lenders. Treasury is an important potential source of expertise on internal uncontrolled transactions and market data. Having tax and treasury specialists working together unlocks benefit from these synergies and helps address upfront any inherent differences in the approaches. Co-ownership of transfer pricing of financial transactions by tax and treasury appears a natural and straightforward process. Practical challenges, however, often lie in timing, definition of mandates and role within each function, their respective priorities, understanding of inherent differences in practices and methodologies used by Treasury and tax. The bigger the multinational group and the larger the number of individual transactions and their size, the more palpable tend to be the challenges, and the more significant tend to be potential consequences, including lost tax savings, incompliance with tax laws, withholding tax leakages, process inefficiencies, to name just a few. To wrap up, in the current landscape of the aggressive tax audits and stricter BEPS-induced rules on the horizon, many companies, we believe, would benefit from revisiting their policies, processes, and procedures to ensure strong cooperation between tax and treasury when it comes to planning and implementation of intercompany financial transactions. Thank you for watching.